Hello, welcome.
Imagine two people. Both have a $6,000 limit. Both charge $2,300 on furniture. Both pay the entire balance in full, on time, every single month. Neither one ever pays a dollar of interest. One of them watches their score climb toward 800. The other watches it slide 25 points for no reason they can explain. Same income, same spending, same discipline, different outcome. The difference isn't how much they earn. It isn't how responsible they are. It's a single date on a calendar that almost nobody checks. And today I'm going to show you exactly where to find it, why it matters more than your due date, and how a 48-hour adjustment can change the number that decides whether you get approved for a mortgage, a car, or a better rate on both. Welcome to Money Autopsy. This channel exists for one reason: to translate the fine print that banks bury on page 4 of your cardholder agreement into decisions you can actually use. Today's topic is credit utilization, and I'd argue it's the single most misunderstood number in personal finance. Not because it's complicated, it's just division. It's misunderstood because almost everyone is taught to watch the wrong date. If you find this useful, the subscribe button is right there. I put out a new breakdown like this every week. Here's the assumption almost every cardholder makes, usually without realizing it. They think the credit bureau is watching their account in real time, like a bank teller standing behind the glass. Spend on Monday, balance goes up. Pay on Friday, balance goes down. Bureau sees both. That's not what happens. Your credit report isn't a live feed. It's a monthly photograph, and the camera only clicks once. On your statement closing date. Whatever your balance is on that one day is the number that gets mailed off to Experian, Equifax, and TransUnion. It sits on your report untouched until the next photograph is taken 30 days later. Your due date has nothing to do with this. Due date only controls whether you pay interest. Statement date controls what the world sees. Walk through a typical cycle. Your billing period runs the 1st through the 30th. You swipe your card all month. Groceries, gas, a plane ticket. By the 30th, your balance has climbed to $2,800. That's the moment the camera clicks. The statement generates. $2,800 gets reported. Your due date might not arrive until the 25th of the following month. So you could pay that $2,800 down to zero on the 10th, 3 weeks before it's even due, and it wouldn't matter. The bureau already has its photograph. It's not getting a second one until your next statement closes. This is why people with perfect payment habits still watch their score dip after a big purchase. They're not being punished for irresponsibility. They're being scored on a snapshot taken at the worst possible moment, right before they cleaned it up. Let me make this concrete with a story that plays out constantly in the comments section of channels like this one. A couple, we'll call them the Reeses, decide to renovate their kitchen. They open a new store card with a $40,000 limit specifically for the project, because the contractor offers 0% financing for 18 months if they charge the full renovation to that card. Smart move on paper. No interest, predictable payments, and they have the cash sitting in savings to pay it off completely whenever they want. They charge $38,000 to the card the week the cabinets and appliances arrive. 95% utilization on a brand new account. 2 weeks later, before their first statement even closes, they apply for a refinance on their mortgage to lock in a better rate. The refinance gets denied, not because of income, not because of payment history. The automated underwriting system flags a single line item, a newly opened account reporting 95% utilization. To the algorithm, that pattern doesn't read as smart 0% financing. It reads as someone who just took on a large amount of debt relative to their available credit. Full stop. Context doesn't travel with the number. Here's what they didn't know, and what almost nobody explains when you sign up for one of these promotional cards. The 0% APR protects you from interest. It does nothing to protect your utilization ratio. The statement still closes with whatever balance is sitting there, and that balance still gets reported exactly like any other debt. Had they known about the timing mechanics in this video, the fix would have been simple. Make a large paydown from savings before the first statement closes, dropping reported utilization to something closer to 45%. then continue paying down the 0% balance on its normal schedule. Same renovation, same 0% deal, dramatically different footprint on the credit file at the exact moment they needed clean numbers. The lesson isn't don't use promotional financing. It's that any large balance, regardless of the interest rate attached to it, gets photographed the same way. The algorithm doesn't know or care that you're paying 0%. It only sees the ratio. You might think, fine, so the Bureau sees a higher number for a few weeks. Does that really move the needle much? It moves it more than almost anything else you control day to day. Breakdown of FICO score and payment history takes the largest single slice at 35%. Right behind it, at 30%, is amounts owed, which is driven almost entirely by utilization. That's nearly a third of your entire score, and unlike payment history, it can swing wildly in a single reporting cycle. The math is simple. Balance divided by limit. $600 owed on a $2,000 limit is 30% utilization. Scoring models treat 30% as the first real warning line. Cross it, and your score takes a hit. Cross 50%, and the hit gets sharper. Approach 90 to 100%, and the algorithm starts treating you the way it treats someone who might be heading toward default. Because historically, that correlation is real. And here's the part people miss. This gets calculated two ways at once. There's your overall utilization across every card combined, and there's per card utilization. You can have $40,000 in total available credit, but if one card with a $1,000 limit is sitting maxed out, that single account drags your score down on its own. The algorithm doesn't average it away. One piece of good news, utilization has almost no memory. Miss a payment, and that scar sits on your report for 7 years. Run your utilization up to 80% 1 month, and pay it back down the next. And your score largely recovers as if it never happened. It's a snapshot, not a scar, which is exactly why controlling the snapshot matters so much. Before we go further, one distinction that saves people a lot of unnecessary panic. Utilization only applies to revolving credit. Credit cards, store cards, and lines of credit where your balance can go up and down, and your limit stays fixed. It does not apply the same way to installment debt. Auto loans, student loans, personal loans, mortgages. Those accounts are scored on whether you're paying on schedule, not on what percentage of the original loan is still outstanding. A $30,000 car loan with $28,000 left on it isn't dragging your utilization the way a $30,000 credit line sitting at $28,000 would. This matters because people sometimes panic pay down the wrong debt. If your goal is a utilization boost before an application, throwing extra money at your car loan does almost nothing for your score in the short term. Throwing that same money at a maxed out credit card, even temporarily, moves the needle immediately. Know which bucket your debt sits in before you decide where the extra payment goes. Buy now, pay later plans occupy a strange middle ground worth a quick mention. Historically, most BNPL providers didn't report to the major bureaus at all, which meant they had zero effect on utilization either way. That's been changing. Several major providers have started furnishing data to Equifax, and in some cases TransUnion, and how those balances get classified is still evolving. If you're leaning on several BNPL plans at once heading into a mortgage application, don't assume they're invisible. Pull your actual credit report and check. So the instinct is obvious. Get every card to report a $0 balance and you're golden, right? Not quite. And this is where a lot of otherwise well-informed people leave points on the table. A credit file that shows $0 balances everywhere, month after month, gives the scoring model nothing to evaluate. It can't assess how you handle debt if you never appear to be carrying any. Counterintuitively, a small, consistently reported balance tends to outscore a permanent zero. Data on top-tier scorers backs this up. Cardholders sitting at 830, 850 typically report utilization somewhere in the low single digits, not flat zero. They're not avoiding credit. They're using a sliver of it and paying it off, every cycle, on record. This has a name in credit optimization circles. AZEO, all 0 except 1. The mechanics are straightforward. Say you're carrying 5 cards. Before each statement closes, you pay 4 of them down to a true dollar. On the 5th, you leave a small reported balance. A coffee, a tank of gas, something in the 1 to 3% range of that card's limit. That one card shows activity. The rest show discipline. Together, that combination tends to score higher than 5 zeros across the board. And to be clear on the part that trips people up, a reported balance is not the same as a carried balance. You still have until your actual due date, typically 3 weeks after the statement closes, to pay that small amount in full. 0. Interest. The score benefit and the interest-free benefit aren't in conflict. They're just governed by 2 different dates. Theory's easy. Execution is where this falls apart for most people. And it falls apart for one specific reason. Autopay. Autopay set to pay full statement balance is built to protect you from late fees, not to optimize your reported balance. By the time autopay fires, the statement has already closed, and the damage, if there is any, is already on your report. If you want control over the snapshot, you have to step in before the statement generates, not after. Here's the actual sequence. Find your closing date. It's usually buried in the statement PDF, not the app's home screen. Apps tend to spotlight the due date because that's the date that benefits them. Look for billing cycle or statement closing date. Set a recurring calendar reminder 2 to 3 days before that date, giving transfers time to post. Pay down manually before the cycle closes. On your reminder day, check your current balance. If you're carrying $900 and want the statement to reflect something closer to 1 to 2%, send a manual payment that brings you down to roughly $20 to $30. Don't wait for the scheduled autopay run. Initiate it yourself. Let the statement close and confirm the number. When the new statement lands in your inbox, it should reflect the low balance you engineered, not the higher balance you actually carried mid-cycle. That's the number now sitting on your credit file. Still pay the remainder by the due date. Whatever small amount is left needs to be paid off by the actual due date to avoid interest. Manually confirm this the first several times you try the process before trusting autopay to catch it. One caveat worth being honest about: this isn't something you need to run on every card, every month, forever. It's most valuable in the window before a mortgage, auto loan, or any application where every point counts. Outside of that window, keeping your general utilization under 15 to 20% and letting autopay run normally is enough to stay in strong shape without the manual upkeep. There's a version of this that goes too far, and it's worth a direct warning: credit cycling. If you have a $1,500 limit and you spend it, pay it off, spend it again, pay it off, and spend it a third time in the same billing period, you've technically moved $4,500 through a $1,500 limit. To you, that might feel like proof you're a great customer. To a card issuer's risk team, repeated maxing and clearing within a single cycle can look like structuring, a pattern associated with laundering or bust-out fraud, even when the intent is completely innocent. Issuers extend a limit because that's the exposure they're comfortable holding with you. Routinely pushing 3 or 4 times that amount through the account, even responsibly, can trigger a manual review, a request for income documentation, or in worse cases, an account freeze. If you find yourself needing to pay down a card mid-cycle just to keep spending on it, that's not a sign you need a smarter payment hack. It's a sign you need a higher limit. Call the issuer, point to your on-time payment history, and ask directly. A $1,500 purchase on a $15,000 limit is 10% utilization without any manual timing at all. Sometimes the simplest fix is just more room. While we're on the subject of limits, resist the urge to close old cards you're not using anymore, even if the account feels like clutter. Utilization is calculated against your total available credit. Close a dormant card with a $12,000 limit and 0 balance, and your total debt doesn't change, but your total limit just dropped by $12,000. The percentage on top of that fraction jumps immediately, even though your actual spending didn't move at all. Keep old accounts open. Attach a small recurring charge. A streaming subscription is the classic move. Set it to autopay and let the card sit quietly in the background, padding your available credit without any ongoing effort from you. Everything above assumes you already have a card with meaningful room to work with. If you're new to credit or rebuilding after a rough stretch, the utilization game looks a little different, And it's worth addressing directly instead of assuming everyone watching has a $20,000 limit sitting idle. Secured cards are the standard entry point, and they're more useful than their reputation suggests. You put down a deposit, often $200 to $500, and that deposit becomes your limit. The trick people miss: request a slightly larger deposit than the minimum if you can afford it. A $500 secured limit gives you far more breathing room to stay under 10% utilization than a $200 one, and the deposit isn't spent. It's just collateral you get back when you upgrade or close the account in good standing. Becoming an authorized user on a family member's well-established card is the other major lever, and it's underused. When someone adds you as an authorized user on a card with a long history, low utilization, and a high limit, that entire account's history can appear on your report, including its utilization ratio. This is one of the few legitimate ways to improve your utilization picture overnight, not over months. The caveat: it only helps if the primary cardholder actually keeps their utilization low. Being added to someone else's maxed out card imports the problem, not the benefit. Credit builder loans, offered by many credit unions and community banks, work differently. You don't get the money up front. You make payments into a locked savings account, and the payments themselves build your payment history. They don't touch utilization directly since they're installment products, but they're a useful parallel track while your revolving utilization habits are still developing. The common thread across all three: none of them require you to carry a balance or pay interest to see benefit. The myth that you need to use debt to build credit in the sense of paying finance charges is exactly that: a myth. Small charges paid in full, reported at a low percentage, is the entire formula, regardless of which of these starting points you're using. A few quick answers to the questions that show up in the comments every time this topic comes up. Does checking my own score hurt my utilization or my credit at all? No. Checking your own report or score is a soft inquiry. It has zero effect on your score, no matter how often you do it. Only hard inquiries, triggered when a lender pulls your report to make a lending decision, carry any weight, and that weight lives in a completely separate scoring category from utilization. If I pay my statement in full every month, why does my score still fluctuate? Because the balance that gets reported is whatever your statement showed at closing, not $0, even if you paid it off completely a week later. Fluctuation between 5% and 25% utilization month to month, driven purely by how much you happen to spend that cycle, is completely normal and not a sign anything is wrong. Will requesting a credit limit increase hurt my score? It depends on how the issuer processes the request. Many major issuers can approve a limit increase using a soft pull, which has no impact. Some require a hard pull, which causes a small temporary dip. Ask the representative directly which type of inquiry they'll be running before you agree to the increase. It's a fair question, and most issuers will tell you. Does having more credit cards automatically lower my utilization? Only if you don't spend proportionally more. Opening a new card increases your total available credit, which mathematically lowers your overall utilization percentage if your spending habits stay the same. But each new account also triggers a hard inquiry and temporarily lowers your average account age, both of which have a small, separate effect on your score. It's a net positive for most people over time, but not an instant fix, and it's not worth doing purely to chase a utilization number. Most lenders today still score you on FICO 8, which is the pure snapshot model this entire video has been about. No memory, one photo per cycle. But a newer model, FICO 10T, is gradually gaining adoption. It looks at trended data, your balance behavior across the past 24 months, not just the most recent statement. Under a trended model, someone who runs balances high all year and only trims them right before the statement closes becomes more visible because the pattern itself is now part of the data. The single snapshot strategy in this video still works today, particularly for mortgage and auto lending, where FICO 8 remains standard. But it's worth knowing the ground is shifting, and being genuinely low utilization most of the time will age better than being cleverly low utilization once a year. 6 things to take away. 1. Your statement closing date, not your due date, is the number that reaches the bureaus. Find it for every card you own. It's usually buried in the statement PDF, not the app's home screen. 2. Aim to stay under 30% utilization for a healthy score, and under 10% if you're chasing excellent, but don't chase a flat zero. A small reported balance, especially under the AZEO approach, tends to outperform an account that reports nothing at all. 3. Manage this with manual payments, timed a few days before your statement closes, not with autopay alone. Autopay protects you from late fees. It does nothing to optimize what gets reported. 4. Know which of your debts are revolving and which are installment. Only revolving balances, cards and lines of credit, move your utilization ratio. Throwing extra payments at add an auto loan the week before a mortgage application won't help the number that actually matters. 5. If you're building or rebuilding credit, a secured card with a reasonable deposit, or authorized user status on a family member's well-managed account will move faster than waiting it out on a single small unsecured card. 6. Never mistake cycling your limit repeatedly for good behavior. Spending 3 or 4 times your limit in a single cycle, even if you pay it off every time, reads as risk to an issuer's fraud team, not loyalty. Here's the exercise. Pick one card this month, find its closing date. Time one manual payment around it, a few days early. Then check your score after that statement reports. You'll likely see the shift within one billing cycle, and once you see it happen once, you'll never look at a due date the same way again. If this saved you a few points or a denied application, the subscribe button does more for this channel than any single view. I break down one piece of the system like this every week: how the number gets calculated, why it moves the way it does, and what you're actually supposed to do about it. That's it for this one. This has been Money Autopsy. I'll see you in the next breakdown.